Okay, let's unpack this. Today we're diving into Packaging Corporation of America, or PCA, a major player in the packaging industry.
Right.
In a market still finding its footing, how did they not only navigate Q2 2025, but actually thrive? And, what does their big strategic move tell us about the future?
Exactly.
We're taking their earnings call, transcript, and news release, and our mission is to extract the most important insights for you.
What's truly compelling here is how a detailed look at, well, one company's nuanced performance can be a powerful lens to understand broader economic resilience and strategic innovation. We're going beyond the numbers to understand the why is your shortcut to being genuinely well-informed on this.
Let's start with the big picture then. PCA's top-line performance for Q2 2025, they reported a net income of $242 million,
Yeah.
which translates to $2.67 per share. Now, if you exclude special items, that number was $224 million, or 2.48 cents per share.
Okay.
That's a pretty significant jump from Q2 2024, when their net income was $199 million, or $2.20 per share, excluding those same special items.
Right, a solid increase.
Beyond that, their net sales for Q2 2025 were $2.2 billion, up from $2.1 billion in Q2 2024. And total company EBITDA saw a healthy increase, reaching $451 million compared to $404 million.
And that Dale earns in 7 cents beat on their guidance on top of those solid sales and EBITDA figures. That's earnings before interest, taxes, depreciation, and amortization, a core metric for operational profitability that isn't just a numerical win.
No, definitely not.
It signals strong operational agility and perhaps a conservative initial outlook, or maybe even just better than expected execution in a tight market.
Here's where it gets really interesting, looking at what drove those numbers. On the positive side, higher prices and mix in packaging were a huge boost, contributing $0.98 per share.
Wow, almost $1 right there.
Exactly. And lower fiber costs also chipped in 1313. Even the paper segment added $0.04, and a lower tax rate contributed $0.02.
Okay.
But you mentioned lower operating costs helping them beat guidance, yet also higher operating costs as an offsetting factor. How do we square that for the listener?
That's a sharp observation. Yeah, it highlights the granular nature of cost management. The lower operating costs that boosted their beat likely refer to specific efficiencies or savings in, certain areas, perhaps energy or logistics maybe.
Got it. Specific wins.
But the higher operating costs as a headwind point to broader inflationary pressures they still had to contend with across their entire system. What's truly insightful here is how PCA managed to leverage, selective pricing power in specific segments like packaging,
Right.
while simultaneously making deep cuts in areas like fiber costs. It's a masterclass in surgical cost management, far beyond just broad brush efficiency. It's really a template for how traditional manufacturers can navigate inflation.
So it's not just a blanket cost control, but a really targeted approach. And then we have the specific challenges they face.
Absolutely. They faced higher operating costs, cutting $1.30 per share, and higher annual outage expenses, costing 21 cents, largely due to the Filer City outage being moved into Q2. Other headwinds included lower production and export sales volume in packaging, higher depreciation, higher fixed and other expenses,
Lots of moving parts.
and smaller impacts from lower paper segment volume, higher freight, and higher interest expenses. And just to clarify those special items we mentioned,
Yeah, the 19 cents.
right, the $1.19 per share in Q2 net income from these items was primarily gains from the sale of real estate, partially offset by costs for the pending Grief acquisition.
Okay, so having set the stage with the overall numbers, let's zoom in on the packaging segment, which is truly the engine of PCA's business. What were the standout factors here?
Well, the financial health is clear. A strong 22.6% margin on $2 billion in sales for packaging, up from 21% last year.
That's a healthy margin.
It is. And they really flexed their pricing power, fully realizing earlier announced price increases. Domestic containerboard and corrugated product prices and mix were up significantly over Q2 2024 and even Q1 2025. Export prices also saw slight increases. That's really a testament to their market position.
And on the volume side, while per day shipments were up 1.7% versus Q2 2024, a tough comparable, by the way, since 2024 was up 9% over the previous year.
Yeah, it's a good point.
Overall shipments were flat with Q2 2024, which had one more workday. But crucially, containerboard production was down significantly.
Okay.
85,000 fewer tons than Q2 2024, and 55,000 fewer than Q1 2025 because they made a strategic decision to run to demand. What does that tell us about their confidence versus their inventory management?
That run-to-demand strategy, combined with drawing down 17,000 tons of containerboard inventory, suggests a really disciplined approach to avoid oversupply in a still cautious market.
Right.
They're prioritizing inventory health over simply pushing volume, putting them, as they said, in excellent shape for the rest of the year.
Makes sense.
However, the export containerboard sales being lower than expected, down 24,000 tons from Q2 2024 due to global trade tensions, that's a direct hit.
Yeah, that phrase global trade tensions comes up a lot.
It does. Does the report give any specifics on which regions or tariffs are hurting them most? Or is it possible that competitive pressures in those export markets are also, playing a significant role here?
That's a fair challenge. The report attributes it broadly to global trade tensions, which, yeah, can be a bit of a catch-all. It seems less about specific tariffs and more about the overall unpredictable global climate making buyers hesitant.
Understandable.
So competitive pressures are always in the mix, of course. But despite that, their operational excellence remains stellar, right?
Absolutely. Achieving approximately 99% uptime performance across their system, even with some smaller machines idled due to demand, that highlights their tight operational control.
Impressive.
This allowed them to offset inflationary pressures. What's intriguing is that while customer ordering patterns remained cautious, demand was solid and steady overall.
Okay.
They did note specific segments being off or under duress, like automotive, building products struggling due to high interest rates,
Yeah, that figures.
salty snacks, and sugary beverages. It paints a picture of a resilient core business with specific pockets of weakness tied to broader economic conditions.
So what does this all mean for you listening? PCA is showing impressive control over operations and pricing power, carefully managing production to align with actual demand, even while facing headwinds in certain customer segments and the global market.
And while the packaging segment clearly drives the lion's share of their business, let's turn our attention to the often overlooked paper segment. It tells a slightly different, though equally strategic story. Its EBITDA was $30 million on $146 million in sales,
Okay.
resulting in a 20.8% margin, slightly down from Q2 2024.
And that volume dip, down 5% from Q2 2024 and 7% from Q1 2025, that was due to a successfully completed maintenance outage at their International Falls mill in June, right?
Not demand.
Correct. That's an important distinction. It wasn't a demand issue.
Good. Despite that, they still pushed through price increases, with paper prices and mix up 3% from Q2 2024 and 1% from Q1 2025. Right. But beyond the quarterly numbers, perhaps the most impactful story this quarter is PCA's bold play to acquire Grief's containerboard business, a move that could really redefine their future. What's the core strategic rationale here?
This Grief acquisition isn't just about growth. It seems like a brilliant strategic pivot in a capital-intensive industry. They see it as a well-capitalized business that complements them and offers a very good growth platform with long-standing customers. It allows PCA to expand in areas that would have otherwise required considerable additional capital.
And that's the kicker, isn't it? The capital avoidance.
Exactly. That's the real key. They even noted it as a great cultural fit due to shared dedication to customer needs.
And when you say significant capital avoidance, how significant are we talking? What does that mean in practical terms for their balance sheet and future plans?
It's enormous. Look, building a new box plant now costs around $300 million, up from maybe $100 million not too long ago. A new mill can hit $1 billion, up from $300 million. So by acquiring Grief's well-capitalized facility in the Dallas Metroplex, where PCA was already planning a new plant.
You were, okay.
Yeah, they're avoiding that multi-$100 million expenditure entirely.
So by acquiring existing well-capitalized assets instead of building from scratch, PCA is effectively fast-tracking market expansion and achieving scale years ahead of what organic growth or new construction would allow.
Exactly.
They're bypassing those astronomical new build costs and regulatory hurdles. It's a competitive leapfrog.
That's a staggering figure, truly highlighting the wisdom of this move. And the financial implications look pretty smart, too, with it being structured as an asset acquisition.
Exactly. An asset acquisition provides a depreciation shield, essentially, a way to reduce taxable income by accelerating asset depreciation, and an opportunity for bonus depreciation, allowing even larger upfront deductions.
More financial savvy.
Right. while new debt for funding will add about $100 million in incremental interest at roughly 5.5%.
Okay, that's the cost.
They anticipate tremendous upside from Greece's previous EBITDA of $212 million, including a conservative $30 million just from that Dallas facility alone. This really shows how they're leveraging existing assets for financial benefit.
And a final critical point about this acquisition is its impact on their recycled content mix.
Yes, that's really interesting. It significantly boosts their recycled content from a historical 15–20% to approximately 30%.
That's a big jump.
It is. And Greif's 100% recycled mill in Massillon is strategically located near PCA plants, offering flexibility to produce liner or medium and creating what they call freight positive and fiber positive savings.
So logistical benefits too.
What's particularly noteworthy about this is how this acquisition isn't just about growth, but about strategically managing capital expenditure and enhancing operational efficiency and product offerings in a very capital-intensive business.
Right.
While also improving their sustainability profile. It ticks a lot of boxes.
Looking ahead to Q3 then, PCA expects $2.80 per share, excluding the Greif impact for now. They say profitable volume will be the key driver. How does that translate into their production and cost absorption strategy?
Well, it's all about balancing output with demand to maximize margins. They expect higher corrugated shipments, meaning higher containerboard production.
Yeah.
Bookings are already trending 2% over Q2 2024.
Okay, positive trend.
And sequentially, Q3 is starting about 10% above the last month of Q2 2025, which is a good sign. But they still anticipate lower export sales due to that tricky global trade environment we talked about.
Right, that persists. And they're strategically building some containerboard inventory ahead of a Q4 maintenance outage, which sounds prudent. What about pricing and other costs?
Packaging prices should remain relatively flat, they think. In the paper segment, they expect flat pricing, but higher production and sales volume due to the completion of the International Falls outage and seasonal back-to-school orders.
Seasonality.
Yeah. A nice tailwind is that no scheduled maintenance outages in Q3 means lower maintenance outage expense. Freight costs, however, will be higher due to the full effect of rail rate increases.
Okay, give and take.
Operating costs are expected to be near Q2 levels, with fiber costs maybe slightly lower. It's, a mix.
But the most encouraging sign for me is their observation that customer destocking is done and inventories are incredibly lean.
That's key.
They're seeing demand steadily improve, with even weekend volumes picking up the best in 4 months, suggesting a shift towards 6-day operations. What does that signify for the market as a whole and PCA specifically?
This is huge.
Yeah.
Lean inventories mean any uptick in underlying demand translates quickly into new orders. It suggests real pent-up demand out there.
Right.
And their talk of tremendous upside hinges on those macroeconomic factors, certainty around the global freight issues like tariffs and interest rate movements domestically.
Big unknowns.
If those green lights turn on, they believe it could catapult demand, especially in segments like building products that have been down double digits in the last few years.
Wow.
This raises a crucial question for you listening. How quickly can the market respond once global uncertainties clear, given these incredibly lean inventories? And now, a much better supply-demand balance in the industry thanks to recent mill and box plant closure announcements.
Good question.
It truly showcases the impact of macroeconomics on day-to-day business and PCA's readiness to capitalize.
And that e-commerce trend, growing mid-single digits, combined with it being more of a second-half business, could also provide a nice kicker later in the year.
Definitely something to watch.
So we've truly taken a deep dive today. What stands out is a company delivering strong financial results and operational excellence despite, challenging market conditions,
Right.
making a bold strategic acquisition, and positioning itself for considerable upside when those macro factors eventually align.
The overarching significance here is how companies can adapt and thrive. It's really a testament to meticulously managing costs, leveraging pricing power where possible, and making bold strategic moves like the Greif acquisition, all while acutely navigating the complexities of global trade and domestic economic shifts. It's not just about surviving, it's about setting the stage for future dominance, I think.
Okay, so here's a provocative thought for you to chew on. We discussed PCA's disciplined strategy of running to demand and their customers holding incredibly lean inventories. What happens if those global trade issues resolve and interest rates stabilize faster than expected?
Yeah.
Could this pent-up demand create a market surge so rapid that even well-prepared companies like PCA might find themselves struggling to keep pace? Or will their strategic agility allow them to capture every ounce of that catapulted demand? And what might that mean for their next strategic play?